Hey, what's up my friends? So my name is Rainer, and in this week's video post, I'll be sharing with you on how you're supposed to place your stop loss in the markets, right? Without being stopped out unnecessarily. So how I'll go about doing it is, I'll show you a very typical support and resistance setup, right? I'll show you where it's a logical place to put your stops. And I'll also share with you a very typical dynamic support and resistance trade. And lastly, we'll talk about if you are trading chart patterns, alright, where is a logical place to place your stops as well. So all this and more in this week's video post. I'll see you there. Okay, so the way you should be placing stop loss, a logical stop loss in the market, is at a place where your initial trading idea is invalidated, right? So let me write that down, right? The location should be at where your initial trading idea is invalidated, right? This is where your stop loss should be, where your initial trading idea is invalidated, or the word invalidated here is the same as where your initial trading idea is wrong. So let's understand how this principle can actually help you place a logical stop loss in the market. So let's look at this example. This is the chart of pound Canadian using the principle we mentioned earlier. Say for example, you identify a support area over here and you think that this support level could hold. So if price retrace into this area once again, you want to get long, right? That is your trading setup because you are long in this uptrend. So now the question is, where should you be placing your stops if you are going long into this support area? So recall earlier we mentioned, your stop loss must be at a place where your initial trading idea is invalidated. So your stop loss will be at a location where if price reaches that area, it's telling you that you are wrong. So looking at this chart, where will you be wrong? So needless to say, you can see that this is the support area. So let me change color. So if you ask me, the logical area where you should be at a bare minimum placing your stops is somewhere around here, right? At least around here. Because if price, right, does trade lower, right, and eventually touches your stop, which is at this blue zone over here, chances are on the chart, it's very clear that your support, the support that you have highlighted out over here, is broken. Are you with me? So if your support is broken, it's telling you that your initial trade idea is invalidated because you were long in the first place because price was coming into an area of support. So if your support is breached, it's broken by this amount of margin, it's telling you that clearly, your trading idea is invalidated and you should be getting out of the trade. So this is one example on how you can actually go about, using the principle I mentioned earlier to place your stop loss. So let's look at another example. Let's say, for example, you are not using the classical support and resistance. This time round, you are trading a dynamic resistance. You notice that this red line over here is currently acting as dynamic resistance. So you decided to say, for example, you got short over here because, price retested the red line, which is the 20 EMA, and you got short. So where should your stop loss be once again? Again, using the same principle, your stop loss should be an area where your initial trade idea is invalidated. So what is your trading idea in this chart, in this time frame? Your initial trading idea is that the 20 period moving average will act as a dynamic resistance. So it makes sense that if the 20 period moving average is broken, it's breached, right? It makes sense that you are wrong and you should get out of the trade. So say for example the trade went in your favor and it makes sense to place your stop loss. Let's change it to the blue color somewhere here, because if price does retrace higher and touch this blue area over here, it's telling you that your 20 period moving average, which is currently acting as a dynamic resistance, it's clearly breached, it's broken, and there's no reason for you to stay in a trade any longer. So again, right, we have used the same principle, all right? Your stop loss should be at a place where if it is triggered, it is telling you that your initial trade idea is wrong. So last but not least, let's look at a final trading example. Let's say, for example, you're not trading the typical support or resistance or the dynamic support and resistance, but rather you are trading, say, a head and shoulders pattern. So on this chart, we can identify this is the left shoulder, this is the head, this is the right shoulder, and this is the neckline. Say, for example, you are wanting to trade this head and shoulders pattern. You traded the breakout towards the downside over here. So now, where should your stop loss be? Again, we go back to the first principle. Your stop loss should be at a location where your initial trading idea is invalidated. So where is this location for this head and shoulders pattern? Well, we have actually two options down here. The first option, it really depends on how you define it. If you say that, if price does retrace and trades back towards this blue area here, chances are the head and shoulders pattern would probably looks very distorted, right? Say if price retrace higher all the way up, chances are your head and shoulders pattern is pretty much distorted and there's no reason for you to stay in the trade any longer. But then again, right, some may argue, oh, Rainer, it could be a complex head and shoulders forming up. Well, fair enough. If you are thinking along that lines, then your stop loss, right, your stop loss can possibly go above the head over here. Your stop loss should go above here. Because if the price does retrace all the way back up, taking out this previous swing high over here, clearly we can all now both agree that the head and shoulder pattern is clearly invalidated. So again, this is how you would go about placing stop loss in the market. You don't place stop loss in the market based on some arbitrary number like 1%, 2% price move against you or a dollar amount that you're prepared to lose, because the market does not care how much you're prepared to lose, right? The market is based on structure. So you always want to place your stop loss at a location where your initial trading idea tells you that you are wrong. This is the most objective way, and if you ask me, the best way to place stop loss in the market. Because when you do place your stop loss at an area whereby, if price tells you that you are wrong, then, it makes it very easy to just cut off the trade, because very clearly that price is telling you that, your trading idea is wrong already and it's time to get out right now. So let's do a recap, right? Mainly, right, stop loss, I would advise placing it at a location where your initial trading idea is wrong or invalidated, right? Basically, they are the same meaning. So then we look at, in this video, we look at a very typical support and resistance play. We look at a dynamic resistance setup as well. And last but not least, we covered this head and shoulders pattern, right? On where you should put your stop loss so that this pattern is invalidated. So I hope you enjoyed this week's video post. If there's anything, feel free to let me know, right? You can leave in the comment section below. With that, I wish you all good luck and good trading. I'll talk to you soon.